Ray Dalio, Larry Summers, and Chris Waller, one of the Fed governors, are signaling serious issues with out-of-control inflation, too much debt, and rapidly rising interest rates. I will feature interviews by CNBC and Bloomberg with all three. I'm Ben Ripond. Today is April 19, 2022. Welcome. The intro that you saw, I want to give credit to my son Spencer for putting that together. I saw this headline from CNBC and it said, I want to draw a distinction here. Inflation surged 8.5% in March. It has now become common that the people are taking, even the financial media like CNBC and Bloomberg and CNN, all of them are saying inflation equates to the CPI, the Consumer Price Index. It does not. It is not the same thing. So you will see it all the time, and they say it over and over so that you become oriented to that the CPI is inflation. And you may say, wait a minute, I thought it was. Of course, because they keep saying it over and over, we think that is the rate of inflation. It is not. This chart shows the real rate of inflation when everything is added back in. This is by John Williams of shadowstats.com, and he documented very carefully back to 1980 added back in the things that the Bureau of Labor Statistics from the Commerce Department was taking out of the Consumer Price Index. So he put them back in. So to get a real read without any changes being made to the items being measured or the allocation, you would have to look at the blue line. The blue line tells us that the real rate of inflation, you can tell from the right end of the chart, is over 16%. The red line is after they have removed or played with made adjustments to the Consumer Price Index all the way back to 1980, and they have tried to push that down as low as possible. David McElvaney, in his weekly podcast this last week, cited that he believes that there have been, he says, almost 24. So I take that to mean 22 or 23 times that the Bureau of Labor Statistics has adjusted the Consumer Price Index. All of the times it was adjusted downward. Why was it adjusted downward? You can see in the red line, that looks artificially low. So why did they adjust it down? It is reported many times, and I believe that it was adjusted down so they can minimize the amount that they're having increase that they're having to give to entitlement payments, namely Social Security. So they know, they started this back in the 1990s, they knew that if they stayed with the rate of inflation the way it was going, represented by the blue line, that, of course, we ran out of money anyway, so they just keep borrowing money, but it was going to be even worse if they stayed with the real rate of inflation. So when you hear inflation is at 8.5%, you can look on shadowstats.com. I'll be reporting it every month anyway, but you can see what the real rate of inflation is. Just translate that's 16%. Or you can say, oh, that's a Consumer Price Index, that's not inflation. The differential is about 8%. The reason this is significant is because so much of the financial industry is based on keeping inflation, long-term inflation, the reported number, the red line, down to long-term 2 to 3%. And you hear that term, inflation long-term is 2 to 3%. It's not 2 to 3%. I'll show you in a minute. But they do that because, in my opinion, the financial advisors and money managers can easily achieve a rate of return, or should be able to achieve a rate of return in excess of 2 to 3%. And they can say to you, we're beating inflation. That's not the real number. If they reported the real number, who knows how many would actually even equal the rate of inflation. So your buying power over time would become less and less and less. Let's look at the real rate of inflation. The way to measure this, in my opinion, is through the money supply, money in circulation. That is measured by M2. This comes from the Federal Reserve website, from the St. Louis Fed, and they report on this website that in 1959 there was $286 billion in circulation. Today, there is about $22 trillion in circulation. The difference between those two numbers is a factor of 73 times. So today there's 73 times more dollars in circulation. In other words, since 1959, the dollar has declined approximately 73%. When you look at that over time, that is 7% average annual inflation. Some years more, some years less. It's not 2 to 3%. So this number is not manipulated. This is the correct number, and it is considered a valid measure of inflation. I want to show you 3 videos that talk about, from experts, that talk about the impact of inflation and what's going on. These are Ray Dalio, and we'll begin with him.
Can the dollar stay the world's reserve currency when we are running when inflation is at this high current level and likely to remain this way for some time?
So all currencies have a lot of debt. And so when you look at one relative to the other, there will be a lot of printing. I mean, currency equals debt. And when you hold a currency, you're holding a debt instrument. And so all of those will decline in value relative to other things. Now, will the dollar decline more than other currencies? It's almost certain that we're going to come into this environment. We're in this environment in which there's a shifting of those currencies. So you're going to see more of China's renminbi being used. You're seeing India have a direct link with Russia on the currency. So we're an important change in the currency. But how that is a store of wealth is a different question. So a currency is a medium of exchange and a storehold of wealth. And its storehold of wealth is now a problem, particularly for the dollar, but it's also a problem for other countries. So that's why you have inflation. As money goes into other things, and the cost of borrowing is so low relative to the inflation rate, then it encourages the borrowing of money and the sale of money. In other words, not holding financial assets like that. So that's, yes, I think you're changing the nature of what money is and what the dollar is as a storehold of wealth.
On a scale of 1 to 10, and this is the only way I think I can maybe ask this one, but on a scale of 1 to 10, how concerned are you about inflation right now?
Oh, I don't know, like an 8 to 10 or something like that. We're beginning a paradigm shift. A paradigm shift is a shift from one mindset, and positioning of that mindset to another mindset and another positioning of that. So, for example, the mindset that we were in was that you have low inflation, and when you're owning bonds and you're owning cash, or you are operating one way, and you don't worry about that, and companies don't worry about it in their inventories, or having larger inventories, or homeowners don't worry about inflation as much in the purchases of the houses and so on. Once that shift begins, it causes a reinforcing dynamic. It's like everybody is long bonds. We've been in a 40-year bull market in bonds. And so it's been fine to have. And when that shift starts to take place, you see behavioral shifts that reinforce that cycle in the paradigm. So, for example, when there is the selling of bonds, that it makes it more inflationary in and of itself, because the amount of debt that has to be sold is not just the deficit, but also the amount of debt that's being sold is those bonds. So now interest rates have to rise a lot, or the Federal Reserve has got to come in there and buy more. And then you get wages. People make wage settlements and such things. So a paradigm shift is beginning to take place, and that will be also self-reinforcing. And it's taking place in this context of the conflict, which then creates the breakdown of efficient systems. Each country wants to be self-sufficient. It needs to protect itself. And in being self-sufficient in that way, then you have less efficiencies in the system. And all of that becomes self-reinforcing. So it's all happened before. It's all happened many, many times before. That's covered both in the video and the book. So it's, yeah, I'm concerned about that.
Ray Dalio is the founder of Bridgewater Associates. They're the largest hedge fund in the world. He manages $223 billion in his hedge fund. He makes the point that money is debt. The currency that we have is not real money. It is debt. And that we are going through right now, because interest rates have been coming down for the last 40 years, back to 1981, that we are now entering what he calls a paradigm shift, that interest rates are now going up, and this is causing a shift in bond prices. Bond prices are now starting to go down tremendously, and this is changing the way the whole monetary system. He says, we may go through a shift from where the dollar is the reserve currency to an alternative currency. He mentions Bitcoin, gold, and digital renminbi, Chinese currency. Digital Chinese currency? Really? Even Bitcoin? Really? Because we think the dollar has nothing behind it. Neither does Bitcoin. Neither does the renminbi, or it's very minimal. Gold, I understand. Gold has intrinsic value, but digital currency just piling more on through, it just doesn't make sense to me. He makes the point that the dollar is in trouble, and what's happening with countries now, China and Iran and Russia, even India, are now making payments or requiring payments to be made in other current currencies other than the dollar. The dollar has been the reserve currency since 1944. And since the 1970s, it was the petrodollar. The U.S. guaranteed the payment of money for oil, guaranteed that in dollars, and it became known as the petrodollar. Now what countries are doing is they're going around that, not officially changing the U.S. from the reserve currency, but requiring payments be made in other currencies, continuing to diminish the value of the dollar as a reserve currency. He says more debt, more money printing, rising interest rates, and higher inflation. And we are in a vicious cycle chasing each of those. Next, I'm going to introduce an interview with Larry Summers. Larry Summers is the economics professor at Harvard and the former Treasury Secretary of the United States.
So Larry, we got those CPI numbers out. They came in just about as bad as everybody expected they would. Let me ask you, do you think we're peaking in the inflation now? Because some people think this is about the peak.
I think we're probably peaking for the next several months. There was a huge component from gasoline this month that I don't think will be repeated in the next several because of the base year effects. I think the number is going to come down. Whether we're peaking indefinitely, I'm not at all. I'm not certain that that's going to happen. It'll depend on luck, and it'll also depend on the decisions that the Federal Reserve makes.
And one of the questions is how sticky it's going to be. There's this trimmed mean way of calculating inflation, which is now up at 6%. It's the longest in history since 1984. What do you make of that?
Look, there's been an effort, as there always is when you have inflation, to dismiss it as due to specific or temporary factors. That is much more wrong than right. You can see it when you take out all the extreme observations in both directions, as that calculation does. You can see it, as I've emphasized, by looking at the wages, which are the ultimate source of costs in the economy. We've got a pretty fundamental inflation problem in our country. You know, David, I saw something recently that brought this home to me. People think of us as having had 13, 14% inflation in the 1970s, but that's only because of the way it was calculated then. If you use the same way we calculate inflation now, it got just above 10% in the 1970s. So getting to 8.5, we're actually closer to being back there than I think most people realize.
So given that, and that's a really interesting fact, I must say, I did not know that. Given that, what should the Fed's realistic goal be right now? I mean, they cannot get it back to 2% by next month, goodness knows.
No, look, I think we need to go back to the old idea of price stability as being when people aren't thinking about inflation as part of regular economic calculations. And we need to move away from the detailed fixation with numerical targets, which it seems to me has led us to unhealthy places. So I'd go back to a general definition of price stability, but we are nowhere close to that right now. And I would worry about the clamor of voices that are saying that, 4% inflation could be okay, or even that inflation above 3 could be okay. I think we need to be very determined to come way down from where we are right now.
Larry, there was a Bank of America survey of fund managers out this week, and the big headline was concerns about stagflation. It's higher than it's been since certainly 2008 or so. How concerned should we be about stagflation?
I think it's the most likely place we're going to be. If stagflation means rising unemployment and still high inflation, I think that's the preponderant probability as to where we're going to get over the last couple of years. Over the next couple of years. As I've said before on your show, David, the painful fact that needs to inform our view is that we've never had a moment when unemployment was below 4, inflation was above 4, and we avoided recession for the subsequent 2 years. And right now, unemployment's well below 4, and inflation is well above 4. Lots of people say, look, the job market is so strong, why would anyone think we're going to have a recession? What the data show is that the lower unemployment is, the more likely it is that it's going to turn down in subsequent months.
Larry Summers points out that we have a real problem. Those are his words. We have a real problem. The data suggests that we are headed for a crash. He introduces this and he says, all the way back forever, in all of financial history, whenever the rate of inflation is above 4% and the unemployment rate is below 4%, one above, one below, through all of financial history, a crash in the economy has happened within 2 years following that. And I'll call that the Larry Summers 4% rule. Now I want to show you a clip from the Fed Governor, Chris Waller. Chris Waller was the chief research analyst at the St. Louis Fed, which is in charge of the research, data research for the Federal Reserve. He is now one of the Fed governors, and he did this interview with Sarah Eisen on CNBC. And take a listen.
How are you reading the inflation data that we got this week?
Well, the data was high. We knew it was going to be high, so it wasn't that surprising. Oil and or energy and food was going to drive the headline numbers up. We got a little bit of a break on core inflation numbers, came in a little lower than we thought, which is good news. Hopefully we can see that continue going forward. But inflation is it's very high, and we know that this is causing a lot of pain for American households, and we're just going to continue on with our plans with rate hikes and reducing accommodation to try to get this back under control.
You mentioned the core inflation number. The monthly gain was less than it had been, and it sparked this whole debate over whether inflation has peaked. What do you think?
Yeah, I mean, that's kind of what I'm forecasting, is that this is pretty much the peak. It's going to start coming down. That was what I had in my SEP going forward for the second half of the year. Inflation would start to come back down as rate hikes started having a bite on the economy in terms of demand, and that was going to put some downward pressure on prices. We're already seeing some oil prices retreating back from where they were from the invasion of Ukraine. So I think we might be at the peak, and that we'll start seeing some relief on this in the next coming months. But it doesn't relieve us of our job to, remove accommodation and get inflation down.
So on that note, you put out there that you were looking at a potential double or 50 basis point hike in May. Are you still there? And do you think that we're going to require more than one 50 basis point hike?
Well, I think the data has come in exactly to support that type of policy action if the committee chooses to do so. It gives us the basis for doing it. I have said before, I prefer a front-loading approach, so a 50 basis point hike in May would be consistent with that, and possibly more in June and July.
How many is it going to take to get inflation down?
Well, I think we want to get to above neutral, certainly by the later half of this year, and we need to get closer to neutral as soon as possible. Now, we have talked up rates. The market rates have gone up quite a bit since December, even though we haven't actually moved the policy rate. That's all because of our forward guidance to drive up rates. And it's worked. I mean, look at mortgage rates. They're up almost 200 basis points since December, and I think it's starting to show in the housing market. So anyway, the rates are already up, but we probably still need to do some more.
You think housing is slowing? Because I don't know, we keep hearing, first of all, prices are through the roof, and there are concerns that they're not going to come down as a result of lower demand because there's just not enough supply. And so you're going to get into this sort of stagflationary environment in sectors of the economy like housing.
Well, unless people are buying only in cash, at some point those higher mortgage rates are going to have a bite on people's ability to finance a house and how much they can pay. I think we'll start seeing that in the next coming months. I think you'll see some downward pressure on housing prices or moderation in housing price increases. The quantities of houses will still sell, but the prices may not be going up anywhere near what they were the last 2 years.
What about other parts of the economy where we are experiencing severe inflation and price hikes? What can the Fed do about the fact that Ukraine isn't going to plant as much this season, and Russia is basically shut out of the global economy on its important grain and fertilizer and oil exports, at least to the U.S.? How do you cope with those pressures?
Yeah, so that's the thing. We can't really fix these supply chain problems that are out there. All we can do is kind of try to push down demand for these products and take some pressure off the prices that people have to pay for these products. But we can't produce more wheat, we can't produce more semiconductors, but we can affect the demand for those products in a way that puts downward pressure and takes some pressure off of inflation.
So, Fed Governor Chris Waller uses what I call financial speak. He talks in very careful terms, and it requires a listener, in my opinion, to read between the lines. And that's what I was doing, trying to say, what is this guy really saying? And here's what I think he's saying. If you get away from the soft words, he is saying this: the Fed's back is against the wall. They have no options left except to raise interest rates to bring down inflation and to sell assets. So they're now selling $60 billion a month of treasuries and $35 billion a month in mortgage-backed securities, flooding the market with those instruments. This is the reverse of what they did when they were buying $120 billion a month, creating liquidity in the system. Now they're selling them, sucking liquidity out of the system. And he says there is, when she pins him down on this, that there is a plan that they plan to raise rates as much and as frequently as possible. And clearly she says 50 basis points. He says, yeah, 50 basis points, if that's what it takes. So every time there has been the raising of interest rates of 50 basis points, one time of 50 basis points, a recession has followed. What I'm not saying is that it follows the next month or the next week, but it does follow within a relatively short period of time, let's say within the next year. And so he knows when he's saying that people who understand that relationship, that correlation, they know what he's saying. In other words, he's signaling they will do whatever they have to do, including crushing the economy and sending the economy into a recession. Whether it's a deep and prolonged recession, we don't know that much. But we could certainly say what he is saying and what the Fed's actions have signaled is that they plan to do a 50 basis point hike. Key takeaways: have a strong defensive strategy for stock and bond portfolios. The traditional stock and bond portfolio is collapsing. If you doubt me, check your portfolio. It is not doing well. Bonds have crashed. They are crashing. I don't know where the bottom is, but there is a steep decline going on in bonds. And of course, stocks, the same thing, especially technology stocks or NASDAQ related stocks. Be cautious about buying new real estate. If you need to buy real estate for various reasons, that's up to you. I'm just saying if we have an economic crash in our future, which I think we do, then it says basically that real estate is going to go through a correction. We don't see it at this point. Real estate is hot, but that it goes in cycles, and a recession says basically that real estate is going to be in trouble as much as the stock market and the bond market. Pay off debt. If you have the ability to pay off debt and do not have that equated with an equivalent amount of cash that you could pay it off, think about paying off debt and accumulate gold and silver for the kinds of conditions that we're going to be finding ourselves in my opinion. I want to thank you for watching. We have additional videos that I did today that cover some of these topics in more depth. I'm going to go in much greater depth regarding a coming recession. You might want to watch that because it does tie to inflation and the counter of inflation by raising interest rates, etc. And then one on the direction of the stock market, which goes beyond just the stock market. It goes into the bond market and various components of the U.S. market as well as other countries. Thank you for watching.